I am going to show you how to build $1 million net worth by doing absolutely nothing. Financial advice over the last decade was dominated by hustle culture, day trading, crypto flipping, and complex option strategies. These are high-stress, unpredictable second jobs that drain your mental bandwidth for very little reward. This chart maps the performance of day traders over a 300-day period based on data from the University of São Paulo and the SEC. Notice how quickly almost all of them drop below the zero profit line. Within a year, roughly 97% of these traders lose money, and less than 1% achieve predictable, long-term profitability. The anti-hustle fix frames wealth creation as an engineering problem. You build a coded algorithm to capture the market's natural upward drift, relying on systematic automation rather than the luck of a lottery. Predictable generational wealth requires entirely removing human effort and emotion from the equation. By eliminating these variables, you remove the primary source of systemic error in an investment portfolio. Time is the most critical variable in the wealth-generating algorithm. It acts as the primary source of leverage, allowing compound interest to scale your capital without requiring additional labor. The mathematical reality of compounding means that starting early drastically reduces the amount of personal capital you are forced to contribute to reach a $1 million goal. This split bar chart compares two different paths to a $1 million portfolio, assuming a historical market return of 8 to 10%. The bar on the left represents an investor starting at age 22, requiring about $285 a month. The vast majority of their final million is pure earned interest. The bar on the right is an investor starting at age 42, who must inject over $2,000 every single month to hit the exact same target. Waiting just 10 years to start the process forces the investor to contribute nearly double the amount of their own capital for the exact same end result. This is the cost of waiting. Every year of delay geometrically increases the financial burden placed on the investor, as you are forced to make up for lost time with raw, out-of-pocket cash. Time in the market is the ultimate leverage. It forces money to scale exponentially in the background while you focus on high-income skills or your personal life. Manually picking stocks is an error-prone process. The SPIVA scorecard, which tracks active fund managers against market benchmarks, shows that over a 15-year period, nearly 90% of professional, actively managed funds fail to beat a simple index. Instead, we use a broad market ETF as a self-cleansing baseline. You buy a microscopic fraction of the entire market. If a company fails, it is automatically removed and replaced by a growing competitor. You never hold a failing asset to zero. Look at this visualization of the entire stock market as a chaotic array of scattered dots. By applying smart beta, we introduce a digital filter to this chaos. This is the 2026 algorithmic upgrade used to sort the market into organized clusters for higher potential returns. This logic targets historically proven factors. It isolates companies showing strong price momentum, identifies mathematically underpriced value stocks, and groups together businesses with high profitability and low volatility. This logic evaluates corporate balance sheets using pure mathematics. It strips away the emotional bias, the media hype, and the panic of holding a single stock during an earnings crash. Applying these data structures to your portfolio secures a higher probability of yield. You achieve professional-grade results without ever sitting at a screen. Once the logic is defined, advanced AI robo-advisors execute the script autonomously. This moves your strategy from a manual spreadsheet to algorithmic execution. This dynamic pie chart illustrates algorithmic rebalancing. Over time, a portfolio drifts. If your tech stocks grow until they take up 80% of your holdings, your risk profile is compromised. AI-driven platforms detect this, selling off overperformers and instantly resizing your slices back to their original, safe proportions. This rebalancing loop maintains your desired risk profile continuously, operating 24 hours a day without human intervention. These algorithms also perform automated tax loss harvesting. They continuously scan for temporary losses, executing sales to offset your capital gains taxes, and then instantly buying back into the market to maintain your exposure. Predictive dollar cost averaging further optimizes the system. Instead of blindly depositing cash once a month, the AI micro-distributes your investments based on market volatility to secure better entry prices. AI handles these micro-executions with a precision impossible for a human. It saves you thousands in taxes and optimizes every dollar entered into the market. With the technology in place, the focus shifts from the external system to the internal state of the investor. The math and the AI are the easy parts. The true difficulty of the anti-hustle strategy is the silent discipline required to do absolutely nothing when the market drops and the world panics. You have built the architecture. Your deposits are automated, your smart beta logic is filtering the market, and your AI is optimizing your taxes in the background. This automation severs the link between your time and your money. Because the algorithm handles the maintenance, rebalancing, and tax strategy, you reclaim the thousands of hours a typical investor loses to market monitoring. True wealth is built silently. By letting the algorithm do the heavy lifting, your mental bandwidth is freed up to travel, network, and scale the skills that actually require a human touch.